Welcome back to the deep dive. Today, we're going to take a deep breath and jump right into the full financial stack of a major global asset manager. We're looking at their full year and Q4 2025 earnings report.
Right. And if you just caught the headlines, you saw the big flashy numbers, record inflows, huge profits.
Exactly. But our mission here is to go beyond that noise. We want to get into the nuts and bolts.
That's it. We're here to figure out the structural reasons why the firm itself called 2025 one of the strongest years in its history. This isn't about luck or market timing. It's about strategy.
And it's also about their future, this massive integration project they've undertaken. So let's set the stage. The numbers really are staggering. We're talking nearly $700 billion in net new assets for the year.
Which, just for context, is more than the GDP of a lot of countries, all flowing into one firm.
And it wasn't just low-fee money either. That capital flow translated into an impressive 9% organic base fee growth.
And that's the metric that really tells the story. It means clients were buying into products that generate sustainable, recurring revenue. It shows real conviction.
That conviction is a perfect entry point for our first segment, the 2025's scorecard. Let's just start with the top-line scale. Full-year revenue hit $24 billion.
That's a 19% jump year over year.
And operating income was, what, $9.6 billion, up 18%?
Right. And earnings per share, the bottom line, hit a new record, up 10% to $4.89. I mean, these are just numbers that show a complete mastery of scale.
But it's more than that. They have this philosophy, right, that they're a share gainer when there's money in motion.
Exactly. They're not just riding a rising tide. They're built to capture capital flow no matter which way the market is heading. Volatility, whether it's turmoil or a rally, actually benefits them because they have solutions across the entire spectrum.
Which brings us to this idea they talk about, the whole portfolio strategy. It sounds good on a slide deck, but what does it actually mean in practice? They say they're winning mind and wallet share.
It means they're moving beyond just selling, a single ETF here or a private credit fund there.
So it's more consultative.
It's completely consultative. They go to a massive pension fund or a wealth manager and say, look, we can analyze your entire portfolio, all your liabilities, and then build you a solution.
A solution that spans public and private markets.
Public, private, active, passive, all of it. All on a single integrated platform. That creates incredibly sticky clients. It makes it almost impossible for a competitor to come in and just pick off one piece of the business.
But doesn't that create a ton of complexity? I mean, trying to be everything to everyone seems like a huge operational lift.
It is a huge lift.
Yeah.
And that's why you see that the growth was so incredibly broad-based. The sources point out that something like 150 different products.
150.
Yeah. Across their ETFs and mutual funds, each had over $1 billion in flows. That tells you they're managing the complexity by offering very specific, differentiated options. No single product is doing all the heavy lifting.
And if we look at the momentum into the end of the year, the fourth quarter it just screams acceleration.
It really does. Q4 revenue was $7 billion, up 23% year over year.
But the real kicker for me was the organic base fee growth. 2 straight quarters of double-digit growth.
Tapping it off with 12% in the fourth quarter. That 12% is so critical because it proves the new strategy is firing on all cylinders.
So 2025 was about scale and execution, but the plan for 2026 is, frankly, on another level. Let's move to segment 2, the new model. We keep hearing this phrase, a fully integrated firm.
This is the definitive strategic pivot. They're entering 2026 as a single, unified company after absorbing these huge strategic acquisitions. We're talking about GIP, Prekein, and HPS.
And the goal isn't just to be bigger.
No, not at all. The stated goal is to pioneer what they're calling the asset management model of the future.
Okay, so let's define that model. Because those 3 firms you mentioned, GIP, HPS, Prekein, they are very specific pieces of this puzzle. What does this integration actually look like for a client?
The model is all about seamless interoperability. It means your traditional bond portfolio can sit right alongside your stake in a private infrastructure project.
And it connects old and new financial systems.
Exactly. Bridging traditional finance with, decentralized ecosystems. So GIP gives them instant global scale and infrastructure. HPS brings deep expertise in private credit. And Prekein adds the critical data and analytics layer.
It really does sound like they're building a single, all-encompassing financial ecosystem. And for that to work, the tech has to be flawless. That's where Aladdin comes in.
Aladdin, eFront, and now Prekein. Absolutely. The technology business is now this formidable software as a service franchise.
Yeah.
It's already pulling in nearly $2 billion in revenue.
Then growing at, what, 24% year over year?
24%.
Hmm.
So the tech isn't just an internal tool anymore. It's a high-margin external business that pulls all these different client assets together. Preqin alone added $65 million in revenue in Q4.
So when you step back and look at the scale of this whole integrated platform, it's just breathtaking.
It is. I mean, they now have the world's #1 ETF franchise under one roof.
The engine that brought in over $500 billion last year.
And at the same time, they've built a top 5 alternatives platform with over $675 billion in client assets. Its dominance at both the most liquid and the most illiquid ends of the market.
That's the perfect setup for segment 3, the growth engines. We've talked about the scale, but let's get specific. Where were the biggest engines in 2025?
Well, the star player, without a doubt, was iShares. It set a new industry record, $527 billion in net inflows,
Just incredible numbers.
which works out to 12% organic asset growth and, more importantly, 13% organic base fee growth. And it was diversified growth, too: equity, fixed income, active, even digital asset products.
And the retail segment was also huge, net inflows of $107 billion. But that was skewed by one massive event in Q4, wasn't it?
It was, yeah. The big driver there was onboarding an $80 billion SMA assignment from Citi Wealth.
And for anyone listening, an SMA, a separately managed account, isn't just a mutual fund, it's a customized portfolio.
Right. It's a high-touch solution for wealthy clients. Winning a mandate of that size shows they're making serious inroads into that customized wealth management space.
We should also touch on cash management. It's often overlooked, but it pulled in $131 billion in net inflows for the year.
Cash management is a real sign of client trust. The flows came from the usual places, U.S. government funds and so on, but also, and this is interesting, from their Circle Reserve funds.
So that's where the digital asset strategy starts to pay off.
Exactly. You're seeing it show up on the balance sheet, positioning them right in the middle of the stablecoin ecosystem.
Okay, so we have this picture of massive growth everywhere, but we have to address the contrast here. Institutional Index saw net outflows of $119 billion. What's that telling us?
You know, at first glance, it looks bad, but if you connect it to the bigger picture, it actually looks like a very calculated trade-off.
That's strategic rotation.
I think so. The outflows were mostly from very low-fee institutional index equity products. This isn't clients losing confidence. It's the firm actively guiding clients toward higher fee, higher value add areas in their private and active businesses. They're shedding low-margin assets on purpose.
To free up capital and focus on areas with, that 9 or 10% organic growth potential.
That's exactly it. They're explicitly building out these new high-growth franchises. Private markets for insurance, private markets for wealth, digital assets, active ETFs.
And they've put some very aggressive targets on those.
Very aggressive. They think each one of those new areas can be a $500 million revenue generator on its own within 5 years.
Wow. And what about the private markets fundraising goals specifically? With GIP now in the fold.
They're targeting $400 billion in gross private markets fundraising through 2030. It's a massive number, and the only way they get there is by leveraging those deep relationships they have with sovereign wealth funds and huge corporations.
Let's pivot to segment 4 then, financial nuance and capital strategy, because you can't fund this kind of growth without rock-solid financials. So how are they treating shareholders through all of this?
Well, they're clearly confident. They returned a record $5 billion to shareholders in 2025. But what's really telling is the board just approved a 10% increase to the Q1 2026 dividend.
That's the biggest dividend hike since 2021.
It is, and it's a huge signal from management that they believe this new integrated model is going to churn out substantially more cash in the future.
And they're still buying back stock.
Oh, yeah. They're targeting another $1.8 billion in share repurchases for 2026. A big dividend hike plus buybacks. That's a classic sign that a company thinks its own stock is undervalued.
Now, I want to drill into the margins because this is where you really see the operational efficiency. The reported operating margin for the full year was 44.1%.
Right, but that number gets a little cloudy because of performance fees, which can be unpredictable.
So you have to strip those out.
You do. And this is a really crucial nuance. If you take out the performance fees and the compensation tied to them, The adjusted operating margin for the year was actually 44.9%.
And why is that 0.8% difference so important?
Because it represents real margin expansion on their core recurring foundational fees. That 44.9% is 60 basis points higher than it was in 2024. It proves that as they scale up these core businesses, they're getting more and more efficient.
We do have to touch on one little red flag, though. A non-operating result in Q4 that shows the risk in this new strategy. That $106 million net investment loss.
Yeah, that was a non-cash mark-to-market loss. And it was tied to their minority investment in Circle.
The stablecoin company.
Right. So this loss is a direct result of their decision to play in the volatile crypto world. They see it as a key part of bridging traditional and decentralized finance, but it comes with risk. They still hold over 1 million shares.
It's a good reminder that playing in these new sandboxes isn't always smooth. So last thing, a quick look at future expenses. What's the guidance for 2026?
The key word is efficiency. They're expecting a tax run rate around 25%. And incredibly, despite integrating 3 huge companies, they expect headcount to be broadly flat in 2026.
So let's bring this all together for you listening to this deep dive. The key takeaway here is that 2025 was a year of, well, acceleration, but more than that, integration.
And because of that integration, they are entering 2026 at a much, much higher run rate for their base fees. We're talking about 35% higher than their base fees were back in 2024. That is the structural reset of the entire business.
A fundamental change.
And that change lets them leverage their incredible scale, their unique visibility with governments and corporations all over the world. That position gives them insights, it gives them deal flow that almost no one else on the planet can access.
And this is where it gets really interesting, and here's something for you to think about. Given this explicit push to integrate everything, public markets, private markets, traditional finance, decentralized finance, how might this actually redefine what an investment portfolio even is?
It's a profound question.
If they successfully unify GIP, HPS, and Preqin, will that traditional line between a public investment and a private one just disappear? Could we see a truly unified capital allocation strategy for the world's biggest investors in the next few years? Because that seems to be the ambition we just spent this whole deep dive analyzing.
It's a huge shift. And if they pull it off, the rest of the industry will be scrambling to catch up. That unified approach is absolutely what we'll be watching as their 2030 goals get closer.
Thanks for diving in with us. We'll see you next time on The Deep Dive.